Hi students, we are going to see company accounts today. Here they are starting with the meaning and definition of a company, okay, which is already given by means of characteristics of a company, okay. Let's see the characteristics one by one. It is a voluntary association, right? A company is a voluntary association of persons. No law can compel any person to form a company. So only if they agreed to create a company by their voluntary means, they can form a company. No compulsion to form a company for any person, right? And there will be a separate legal entity, meaning it is an artificial person. So it has a separate legal entity which is separate from those members meaning the shareholders, right? And common seal. A company may have a common seal which is to be affixed on a document, because persons cannot sign on behalf of a company. So company will have a common seal. Perpetual succession, that means the company will continue for forever, no matter whichever member is going to quit from the company, right? It can be wound up only by law. Okay, limited liability. So all the shareholders of the company has their liability to the extent of the value of shares held by them. And transferability of shares. The shares of the company are freely transferable. Okay, only in case of a private company they cannot transfer the shares from one person to other, but in public company they can do it. Now we see meanings and types of shares. There are two types of shares. One is preference shares, the other one is equity share. What is preference share? The payment of dividend to the preference shareholders is given much preference, right? And this is not happening. For preference shareholders, dividend at a fixed rate is paid throughout the lifetime of the company, and preference towards repayment of capital during winding up of the company when it is a preference share. But for equity shareholders, they are paid only after the preference shares. They do not enjoy any preference right. Okay, there is no fixed rate of capital. They are paid according to the profit earned by the company. Okay, in case of winding up of a company, equity shareholders are paid only after the payment is made to the preference shareholders. Now let's see what are the divisions of share capital, right? How the capital is divided. First, let's start with authorized capital. So authorized capital is authorized by the memorandum of association. This is the maximum amount of capital that the company can raise. Okay, beyond this limit, a company cannot raise any capital, right? And issued capital, this represents the part of authorized capital which is offered for subscription to the public. For example, if the authorized capital is, take for example, is 1 lakh, the company can issue only for 10,000. Okay, that is called issued capital. Subscribed capital refers to the part of issued capital which has been applied for and allotted by the company. Out of 10,000 which is issued, if it is only 5,000 subscribed by the people, allotted to the people, then it is called subscribed capital, right? Called up capital. Okay, now 5,000 is subscribed by the people. Okay, people were ready to pay for 5,000, but called up capital is for which the company is calling people to pay, right? To make the payment to the company. That is called up capital. What is paid up capital? They called up for example 3,000, right? But they got paid only for 2,000. Then that is called paid up capital. And reserve capital is something the company can reserve as a part of its subscribed capital to be called up only at the time of winding up, not now. It is called reserved capital. Let's see how issue of equity shares happens, right? Public issue is like issue of shares to the public through prospectus to the general public. Okay, it is called public offer. Private placement is like the shares are issued or offered to the selected group of persons by a company, okay, through a placement offer letter, which has to satisfy certain conditions specified in section 42 of the Companies Act. Right issue is the issue of equity share to the existing shareholders who is already holding the shares of the company through a offer, letter of offer. Bonus share is again to the existing shareholders, but it is free of cost. Out of accumulated profit of the company, they issue bonus shares to the existing shareholders. What is the process of issue of equity share, right? How the process goes. So it has to be as per the provisions in the Indian Companies Act, and also it should follow the guidelines issued by the SEBI, Securities and Exchange Board of India. First they have to invite for subscription. A public company has to issue a prospectus and invite people to subscribe for their shares. Second step is receipt of application. On the basis of prospectus, people can deposit the money in the scheduled banks along with their applications, and the money of application, like, it will be minimum of 5% on the nominal value of shares. Okay, allotment of shares. So what happens after they apply? So company, after receiving the application, they will do allotment of the shares. If the company is not able to allot any shares to the applicant, they will have to refund the application money that is received. Okay, if the minimum subscription what the company intended to receive is not received, all the application money received has to be refunded to the applicants. Okay, and the equity share money, right, the value of shares can be received in installments and also one time, like a lump sum amount. Also there are two methods. Okay, when we see issue of shares for cash in installments, this is how the installment call goes, right? The first installment called application money that they pay at the time of filling up and submitting the application, right? Second installment called allotment money. Okay, second installment is allotment money. Third installment is called first call money, and the last installment is called final call money. So whenever the company needs money, they will call for these stages they will follow, and they will call for money for receiving rest of the value of shares, right? They don't receive the full value of shares at one go, but they will receive in different installments. So the first one is application money, second one is allotment money, third installment is called first call money, the last installment is called final call money. Okay, another point to note is that the amount of one call, any call money, should not be more than 25% of the face value of shares, right? The call money should not exceed 25%. Okay, so equity shares may be issued for cash at par, that means for the nominal value, or at a premium. Premium means value higher than the share value. Okay, these are the two types of issue that happens from a company. Okay, let's see what are the journal entries that are to be posted at each stage of receipt of money, right? So first we are going to see when shares are issued for cash at par, which means on the nominal price. There is no premium, only on the nominal price, there is no premium into it. So on receipt of the application money, so we are already receiving money, right? So we have to debit the bank account and credit the equity share application account. Okay, so and then an allotment of shares to transfer share application money to share capital, right? So when you allot the shares, you are finalizing those applicants and you are going to issue shares to them, right? So that share application money has to go to share capital account. So here you credited share application account, now you have to debit the share application account and credit the share capital account. Now it is confirmed that it is a share capital. And in case the applications are rejected, right, first you receive the money at a bank and you credited equity share application account. Now you are going to refund the money because you are rejecting the application, so this entry will be reversed here. Equity share application account debit and bank is credit. Okay, and now we are going to do allotment. Okay, if we are going to do allotment, we are going to receive the allotment money, it is due. Okay, we haven't received the money but it is due. In that case, equity share allotment account debit. Okay, we don't debit bank because we have not received it, it is just due. Okay, when it is due, you will debit equity share allotment account to equity share capital account. Okay, now uh, we are going to receive the money, allotment money. So now bank account debit and you will credit this account, equity share allotment account. Okay, and the same concept when the call money is due. If the first call money is due, equity share call account debit, first call account debit. Same way you will, for the second call you will debit equity share second call account. Okay, so equity share call account debit to equity share capital account. Okay, at the time of receiving call money, when you receive the money, you will debit the bank and credit the share capital. I sorry, debit credit the share call account. Okay, so first time during the call itself we are crediting the share capital account, but at the time of receiving money we debit the bank account and credit the call account. Hope this is clear. There is an illustration that is given based on the above explanation. Just have a quick workout on this, you will understand the journals better. Okay, let's see what is under subscription. Okay, a company is issuing shares for a given number, but the public has subscribed only for lesser number. Okay, for example, company is subscribing, let's see an illustration here. Joy company issued 10,000 equity shares for 10 per share. Okay, 5 for application, 3 on allotment, 2 on first and final call. These first and final is put together. Okay, they are not splitting it. So 2 for first and final call. The public subscribed only for 9,000 shares. Okay, the directors allotted all the 9,000 shares and duly received the money. Please pass necessary entries. This is the question. So first time we received application for how many? 9,000. So 9,000 into 5 is your 45,000 received on application, right? So bank account debit to equity share application account credit 45,000. Second stage is allotment, right? Sorry, the application money have to move to share capital. The second step is moving the application money to share capital account. So you credited application account, now you will debit share application account and credit share capital account. So same 45,000 comes up. Second time, equity share allotment account, which is for allotment it is 3 per share. So 9,000 into 3 is 27,000. So first time they call for allotment, then equity share allotment account debit to share capital account credit, which is 27,000, and then when you receive the allotment money, bank account debit and equity share allotment credit. Okay, and same applies to first and final call. First and final call account debit, which is 2 rupees into 9,000 is 18,000 to equity share capital account, and when you receive the money, it is bank account debit to equity share first and final call account. Clear? The same concept comes up wherein you are issuing 10,000 shares, but they are the subscription comes for more than 10,000. For example, 12,000 shares. What happens? So in this scenario, they will use two methods. Okay, they will accept the applications of few people and reject the applications of rest. The second method is they will accept applications of all. Okay, so they will process partial amount for allotment and use the remaining amount of application for the call money, for the remaining call money of those shares. Okay, so any of these methods can be applied by the company as they wish. Let's see this example where Bharat Limited issues 1 lakh equity shares of 10 each, right? On application it is 5, allotment it is 3, and first and final call it is 2. Application money was received for 1,20,000 shares. They are issuing 1 lakh, but we are receiving for 1,20,000. Excess application money was refunded immediately. That means this 20,000 money, the money for 20,000 is immediately refunded. So at the time of receipt, you will receive for all 1,20,000. So this into 5 will give you 6 lakhs. So you will pass entry for all 1,20,000. So bank account debit to equity share application credit. right? And when you transfer the application money to share capital, you will transfer only for 1 lakh, because that 20,000 you are going to return. So 1 lakh into 5, only 5 lakhs is transferred to share capital. Balance 1 lakh is moved to bank, which means to the customer, to the applicant bank account. So equity share application account debit to bank account. From your bank you are going to transfer it, so your bank is credited. Okay, and at the time of allotment, it is 1 lakh share into 3 is 3 lakh. So equity share allotment account debit to equity share capital account. And at the time of receiving allotment money, it is bank account debit to equity share allotment account. At the time of call of first and final call, it is equity first and final call account debit to equity share capital account, which is 2 lakhs, 1 lakh into 2 rupees. And at the time of receipt of call money, it is bank account to equity share first and final call account. Okay. In this category, we are going to see the second type, where we are going to receive more applications, but some of them we are going to use for allotment money. Okay, so Sudha Limited offered 1 lakh share of 10 each to public, 3 on application, 4 on allotment, and balance when required, right? Applicants for 1,40,000 shares were received. So we offered 1 lakh, but 1,40,000 were received. So this is how the allotment happened. How applications of 60,000 shares was fully accepted, and applications for 75,000 shares, only 40,000 is accepted as shares. Balance 35,000 is going to be used for allotment. Okay, and they have rejected 5,000 shares. So out of this 1,40,000 received, this is how they made the allotment. So it is always better to put a table, working table like this, so that you will know how much money, application money was received, how much was used for application, how much is the balance used for allotment, right? So first type, all 60,000 shares are accepted. So 60,000 into 3 application money, which is 1,80,000, which is going to be applied to application only. Okay, in this 75,000 shares, only 40,000 shares are going to be used for application money, and remaining 35,000 is going to be used for allotment. So 40,000 into 3 is 1,20,000, which is going to be used for application. Balance 35,000 into 3, 1,05,000, it's going to be used for allotment money. And 5,000 shares they are going to reject. Okay, applications they are going to reject. So 5,000 into 3, 15,000, which is going to be rejected. And this is how the journal goes. So as you all know, when we receive the application, for all 1,40,000, we already received 3 rupees per share. So 1,40,000 into 3. So bank account debit to share application account, which is 4,20,000. The second entry is transferring application money to share capital account. So we decided to go for only 1 lakh. So only that money you will move to share capital account. So 1 lakh into 3, which is 3 lakh, is moved to share capital account. So what happened to those 5,000 shares, which is going to be rejected, right? So you have to debit the share application account, credit our bank account. So it's going to be 15,000 refunded to the applicants, right? And you remember 35,000, which is 75 minus 40,000, that 35,000 into 3, which is going to be utilized for allotment. So that 35,000 into 3 is going to be moved from share application account to share allotment account, right, which is 1,05,000. And then share allotment, actual share allotment happens for 1 lakh shares only. So 1 lakh into 4, which is 4 lakhs moved to share capital account. And we will not receive all 4 lakhs, because we already utilized the excess money received on application for allotment, right? So 4 lakhs minus 1,05,000 is 2,95,000, which is going to be received from the share applicants. So bank account debit to equity share allotment account only for 2,95,000. Okay. Calls in advance. So sometimes what happens, the applicants pay excess money when they pay application or allotment or calls, right? So that money is kept transferred to a separate account called calls in advance account. Okay, so this amount which is received early will get adjusted in the future payments that is required to be paid by the applicants. Okay, so how will the entry appears, right? Any amount that is received in advance, for example, instead of 100, the applicant paid 110, right? So on that 10 rupees only will be moved to cash call in advance account. So bank account debit, call in advance account credit. So when they want to utilize that money for any call in the future, right, they will debit this account. They credited this account first. Now they want to move it to share call account, right? They will debit the calls in advance account to share call account. There is a illustration that is given on this. You can just go through. It will follow the same procedure where you will get the bank share application money to your bank, and application is transferred to share capital, and then I think only 600 is received in excess into the bank towards allotment, right? So they put only 80,000 for allotment, balance 60,000 they put on calls in advance account, right? And that 600 will be adjusted for calls account, meaning in the future when the call is made, right, bank will in the bank we receive only 19,700 for shares, and this 600 is taken from calls in advance account. We credited there, now we have to debit here, and this value from bank account, right, you have to credit first and final call account. So we actually received from the applicant only 39,400. The money that we already received 600 is going to be adjusted here. Okay, and 40,000 is going to be credited to first and final call account. The money we already received is going to be utilized here. Okay, it is opposite of the scenario that we saw early. Calls in advance we saw, right? Calls in arrear meaning we called for money from the applicants, but they have not paid in full, meaning they made a partial payment. We are yet to receive some amount from the applicant. In such situation, there is again another account is used called calls in arrear account. Okay, instead of debiting the bank fully, you will debit calls in arrear account for the unpaid amount. Okay, let's see one journal. JM Tires issued 15,000 ordinary shares of 10 each, payable as follows: 3 on application, 5 on allotment, and 2 on first and final call. All money were received except one shareholder holding 100 shares failed to pay the call money. So out of 15,000, only 100 shares we did not receive the call money, but for 14,900 we received it. So how do you record it? First time we got the application money, so equity share. Okay, here we are going to pass journal only for the arrear. Okay, pass necessary journals for the call only is asking. So when the journal is asked only for calls, you need not put all the journals. So for call, it is equity share first and final call. For how much it is called? 15,000 into 2, which is 30,000 is called for. So equity share first and final call account to share capital account, but we are receiving how much? Only 14,900 into 2. So that 100 is not received. So bank you will debit only for 14,900 into 2, which is 29,800. The balance 200. 100 and for 100 shares we didn't receive 2 rupees, right? So 100 into 2 is debited to calls in arrear account. So we did not receive full. So we can't debit bank for 30,000. We can debit bank only for 29,800, which is received, and you will debit calls in arrear account for 200, which is yet to be received. Okay, and to equity share first and final call account, which is 30,000. Hope this is clear. And next is forfeiture of shares. Okay, so when a shareholder defaults, he doesn't make payment of allotment money or call money. right? At that time, company has all right to forfeit the shares. Forfeiting shares means cancelling the shares to the extent of share capital. To that extent, share capital is reduced. Okay, and once the shares are forfeited, they ceases to be the shareholder of the company, right? So whatever amount paid by the shareholder is forfeited, it is a gain to the company. We don't repay to the shareholders, okay? It's a gain to the company. So what will be the entry? The share capital, the amount of share capital is reduced to the extent of unpaid amount, and whatever is paid is moved to forfeiture account. So the journal is going to be, share capital is always a credit, right? When we the capital is received, we credit it, but when we forfeit a share, the capital is reduced. Now you have to debit it. So equity share capital account, full called up money you have to enter. For example, we called up for 100, okay? So that 100 is entered here, but your shareholder did not pay allotment money and call money, maybe 50, 30 he didn't pay, but application money or whatever money he paid is 20. Take for example 20. The amount so far paid is credited to forfeited share account. Okay, whatever he did not pay is credited to the allotment money and share money, which is not paid by the shareholder, right? You have, whichever money is not paid by the shareholder, you have to credit both unpaid money and whatever is paid. For example, the application money is paid, that money is moved to forfeited shares account. Actually, this is shown under share capital as a separate head. Okay, it's a gain for the company, so it will be added to your share capital. Okay, so it is a credit which is shown under the share capital. There are couple of examples of the same. So forfeiture of shares is very important, so you can just go through these two examples. You will get it in that small questions type, right? Now we see a reissue of forfeited shares. Now the shares right on the forfeited shares, the shareholders right is now cancelled, so that those shares are remaining open, right? So those shares can be reissued to the public again. Okay, but there are some conditions where if any forfeited share is going to be reissued, that the reissue price should not exceed the unpaid value. For example, the share value was 10 but already paid 4, which got forfeited, right? So you can fix a new price only to the extent of 6, which is 10 minus 4. The new price for those forfeited shares can be only 6 because the 4 was already collected, right? We are not going to sell to the same applicants, however the share price cannot exceed 6. Okay, so in case we are going to sell it for 5, okay, the share value can be 6, but if we are going to sell it for 5, then we are selling it for loss only, so that can be debited to forfeited shares account. Okay, in case we are going to sell the share with at a premium. Premium means more than the share value, right? That premium amount will be credited to securities premium account. Okay, for example, let's see the journals. So once we issue the share at the par, which is the same price, right? At that time, bank account debit to share capital account. Okay, but when it is issued at premium, right? So bank account debit, share capital account debit, credit, but whichever premium amount, which is the extra amount, right, that will go to share premium account, not to share capital account. Okay, when the shares are issued at loss, right? So bank account debit, forfeited share account is debit. The loss amount is debited to forfeited shares account to equity share capital account. Okay, so this is the entry. And supposing you are going to issue share for more price, it is not a premium, but you are going to issue share for more price, then the excess amount can be moved to share capital account. if the reissue price is more than the amount unpaid on forfeited shares, it results in profit on a reissue, which is treated as capital profit and is transferred to capital reserve account. So this is the entry. Forfeited shares account debit to capital reserve account, right? Finally it goes to capital reserve account. Whatever amount was forfeited goes to capital reserve account. And there is a partial proportionate amount of profit to be moved when only part of forfeited shares are going to be reissued. For example, 100 shares were forfeited, okay, and we are going to reissue only 50 shares, okay. In that case, you have to move only the proportional profit to the capital reserve account, right? So for example, total amount forfeited divided by total number of shares forfeited, okay, into number of shares going to be reissued. Only this value is going to be moved to the capital reserve account. There are some illustrations given on the same. You can just go through these illustrations, which is very clear. Yeah. So shares issued at premium. When a company issues share at a price more than face value. So face value is the actual value of share, which is the nominal value, okay. The shares are said to be issued at premium. So for example, share value is 10, but we are going to issue it for 12 rupees. Then the 2 goes to share premium account. Okay, this premium amount used to be received along with the application money or allotment money or in a call. So whichever call they want to make this security premium to be received, they will call for it, and that will be the account to which it will be credited. Okay, so for example, if premium is collected with application money, right? So what are we going to do at the time of receiving application? We will say bank account debit to share application account credit, right? But when we allocate the application money to share capital, we will also allocate the share premium amount. Okay, so if it is going to be 12 received towards equity share application amount, 10 will be allocated to capital and 2 will be allocated to security premium account. So for example, if it's going to be collected, the premium amount is going to be collected with your allotment money or call money, right? So at that time, you have to debit the share allotment account or call account and credit share capital account and security premium account. So for share capital, you will move the share capital only the share value money, and to security premium account, you will move the premium value. Okay, and when we receive the money for the allotment, it is as usual bank account debit to share allotment account credit, right? And when you want to forfeit the share in which the premium is not received at all, okay, we had already credited the security premium, but we are going to forfeit the account. So at that time, you will debit both share capital and share premium account, because you are going to cancel we are going to cancel the amount, right? So you have to debit the equity share capital and also share premium account, and you will have to credit your allotment account, share call account, and also the forfeiture account will be credited. You know, this is the amount that is paid by the applicant, which is not going to be repaid to them. Okay, it is actually gain to the company, as we saw. Okay, on this forfeiture, there were like on these premium one shares, right, there were some illustrations given. You can go through it and then you can work on your actual problems, then it will be very easy. Okay, next is issue of shares for lump sum. So there is no allotment call or first call, second call, nothing happens, right? At the time of application itself, the applicant is paying us the full money. So in that case, what is going to be your journal entry. So first, at the time of application, you're receiving bank your money into your bank, so you will debit your bank to share application account. So this whole money is now transferred to share capital account, and if the share was issued with a premium, then you will credit the security premium account also. There is an example given here which you can go through, which is simple. And for with the premium also they have given another example. I don't want to go through it, it is simple, you can go through. Okay, issue of shares for consideration other than cash. Okay, so we have been seeing all the examples of selling shares only for cash, so the money is received into bank, right? Now what happens in case we are going to sell our shares for other than cash, any asset they are going to give instead of money? How are we going to treat, right? So in this scenario, we are take for example, we are purchasing asset from a vendor. Okay, so usually asset is coming in, so we will debit the asset. So asset account debit to vendor account. We have to pay that vendor, right? So when we purchase an asset, we have to pay him. So he is a credit, he is a liability. So respective asset account debit to vendor account credit. Now instead of paying cash to the vendor, we are going to pay share capital. I mean, we are going to pay shares with the shares, right? So vendor is a credit. Now we are going to pay him. We will debit his account and credit the equity share capital account to the extent of money, share value, right? Share value of money we are going to credit. And in case if it's going to be issued with a premium, then the premium account will also be a credit. Okay, and there is an example. I'll just take you through the example. Rajan Limited purchased a machinery for 6 lakhs from Jagan Traders. Okay, this is the company, and Rajan Limited purchased from Jagan Traders. Rajan Limited is the company. It issued equity share of 10 each, fully paid in satisfaction of their claim. That means they have issued 60,000 shares for 10 each. What entries will be made if such issue is at par? That means 10 only for 10 rupees and at a premium of 50%. 50% of 10 is 5, right? So if it is issued for 15 rupees, what is the entry? If it is issued for 10 rupee, what is the entry, right? So for purchase of machinery, what is the entry? So machinery account debit to Jagan Traders, right? That will be the first entry. Asset is a debit, Jagan Trader is a credit, and we are going to give him share at par. There is no premium, so only share capital is credited. Jagan Trader is debited and share capital is credited only for 6 lakhs only. And when we pay with the premium, right? So machinery account, we purchased machinery for 6 lakhs from Jagan Trader, so 6 lakhs you will say. And so in this example, equity share capital for 10 into 40,000 shares. Let's look into this. Okay, so this means the total liability is 6 lakhs. That means 60,000 shares we can give if this is going to be sold for 10. But if it is going to be sold for 15 rupees, then we can't give 60,000 shares. We can give only 40,000 shares, right? So in 40,000, 10 for share value and 5 for premium. So 4 lakhs goes to share capital account and 2 lakhs goes to premium account. Okay, with this our company accounts ends. Any doubts, you can just post it in the comments. You can go through all the illustrations first and then with the problems. That will help you understand the uh, uh, concept clearly, so that you can work out on the actual practical problems. Thank you.